Top of the morning to you traders. Friday, 15th of November, end of the week at last. Oh, it's been a busy old week this week, and certainly trading-wise a better week than I had last week anyway. So we'll get stuck into prices and what's going on in markets at the moment. First, we'll get through some of the news headlines, the important ones that matter anyway. PBOC, they fixed again 719s, so they're maintaining that level for the moment, despite the actual currency being weaker than that. 722s at the moment has eased a bit. Dollar China CNH has eased a bit off the highs, probably more to do with what's going on in the dollar than anything else. But there was some good data to help it along the way out of China as well. Overnight, we had quite a bit of data. Retail sales, the standout number, 4.8% versus 3.8% expected year on year. Year-to-date sales improving as well, 3.51%. So good numbers there for China. Already people are squawking about green shoots and whatever, but it's a bit early days for that. We've got some industrial production numbers as well. Missed expectations, down on last month, but still up a healthy number, 5.3%. Investment as well, staying pretty decent at 3.4%. Unemployment rate also came down to 5%. So further improvement in data there, as I said, might have helped the yuan strengthen a bit, though I doubt we're out the woods as far as the Chinese economy goes overall, but got to start somewhere, as we well know. Japan's Finance Minister Kato was out on the waffle, saying we'll take appropriate action versus excessive FX moves. He says that one-sided and sharp moves are seen in the FX market. Didn't touch on the fact that they're seeing speculative moves, but he did say that the government will scrutinise the FX market with very high vigilance, including speculative moves. So the speculative line isn't in there in terms of what they think's happening at the moment, but it's obviously one of their watch areas to see if that happens. If we do get comments that they're seeing high speculative moves, then that's just another step up the ladder, rung up the ladder towards intervention. We did get a bit of data out from those guys as well. Industrial production, a little bit of an improvement there, 1.6% month on month versus 1.4%. Some of the other activity numbers improving over expectation as well. Industry activity index 1.9 versus 0.2 expected, so turning around last month's loss. Data out of the UK as well, and not good news for the new government, because on the GDP front, the quarterly number was a secondary revision. Year on year came in a bit below at 1%, but came in worse on the quarter, 0.1%. What wasn't good was the monthly number for September, down 0.1%. Was expected to come in unchanged at 0.2%, so not good news for the new government. Also, industrial production, manufacturing, all coming in negative as well. A lot of red seen across the screens there, so not good news. Bailey's got himself, well, we've got the market talking and various sides talking because he stepped over the political line. It's supposed to be independent, but he came out and endorsed the new Chancellor's UK investment plans. So, as I say, caused a little bit of a stir this morning in, as I say, stepping over that line. But all clowns together, as they say. Over at the ECB, we had the ECB minutes. The real line to take from that is that they see that large persistent undershooting of the 2% inflation target requiring a sustained policy response remained unlikely. So they still see any undershoot of inflation as being temporary. We'll see how that turns out with economies not growing in the Eurozone the last few months and no doubt going forward. The minute said that a few members initially expressed a view that they would have preferred to accrue more information to wait until December before making that cut that they previously did. So that's some of the hawks who have largely been agreeing with cuts thus far, but in the minutes it seems a few might have taken a pause line as well. We had a insiders sources piece out from EconoStream yesterday saying that some insiders are convinced of a 25 pip cut in December and tilting towards another one in January. So all to play for. Still 50 BP cuts are likely off the table. There's been no appetite to see those coming into play. Bit of data out of the US yesterday. PPI data, obviously jobless claims as well. Jobless claims was a nothing burger. Well, it was actually better than expected, moving down nearer the 200k mark than the 300k mark. So still looking okay there. Continued claims as well, still rolling around that area, 1.8 to 1.9. PPI came in a little hotter than expected. 2.4% on the headline number, 3.1% on the core number. So a pip above expectations and going higher. Not a huge difference, it must be said. Nothing that should spook anyone going in, but it just keeps the stickiness in inflation continuing further. And that's something the Fed will and potentially have commented on, as I'll get to now. Fed's Kugler says the Fed must be mindful of both sides of the mandate right now. Disinflation progress stalling could call for the Fed to pause on cuts. If the labour market sputters, appropriate to gradually reduce interest rates. Fed's Barkin says that the current unemployment level is fine. Whether it is normalising or weakening is still something to be determined. Companies still feel that labour is short on a long-term basis. They're not firing workers, though jobs growth is slowing. The biggest risk to growth is probably the unemployment rate. A cycle of layoffs would dampen spending. He said also a significant market correction could cause families with more net worth to slow consumption. So they're talking about the Fed put, keeping that on the table, as it's known. He said unemployment claims are an important indicator of how the labour market is evolving. And it's just shown by the data there. For the jobless claims, that's not showing anything at the moment. He also said weekly credit card spending may also provide a good indicator of the direction of consumption. Now, we do have retail sales today to finish off the week with some US data. So that's going to be closely watched to see if there is any sputtering in the consumer. Now, this data could be a bit funny because it is coming. Obviously, we've had the storm effect potentially in these numbers as well, but we're coming into the big retail period, November and December. So it can be a bit of a funny time for sales. People may be holding off purchases, waiting for the big sale events to come. So this could be a bit of a wild one, and we'll have to see what conclusions we draw from it later on. Retail sales expected to come in up 0.3%. Okay, so that's the one to keep an eye on first and foremost. Then look at the stripped out numbers and the core numbers. We also get the Empire State manufacturing number, the first manufacturing number of the new month. So we'll see if that offers any clues. Expected to improve slightly to minus 0.3. And some import-export price data as well. And there's one of the core sale numbers expected in 0.3%. Well, that's the data. Coming back to Fed heads, Powell was really talking quite undovishly yesterday. He said the economy is not signalling a need to hurry rate cuts. He said we can approach decisions carefully amid a strong economy. They are moving policy to a more neutral setting, but not on a preset path. And he said, if data lets us go slower, it seems like the right thing to do. He said policy is restrictive, but he can't say how restrictive it is. So very undovish comments from Powell. Particularly, he was since he was walking the usual fine line, playing both sides at the last FOMC. Market has obviously reduced expectations for December. Not only that, it's reduced expectations for the path of Fed rates going into 2025. Now, only around 70 basis points of cuts are seen by the end of 2025. So that's effectively less than 3 cuts. Now, obviously, we're in that situation where the market could start getting far too hawkish about where the Fed is going to cut to. Those of you who've been here for a while will remember coming into 2024 how extremely dovish the market was. 150, 175, 200 pips of cuts were getting banged around by various banks and forecasters. And look how extreme that was. Thus far, we've only had 75 pips worth of cuts. And an expectation of another 25 in December. So keep an eye on this because the market might be getting a little bit too hawkish. I think there's a chance it's not too far off. The data is suggesting that they can take a slower approach. Are they willing to pause though, or do they want to get rates down a little bit further just to give them a bit of wiggle room? I'm not so sure. I think if the market's pricing less than 2 cuts for next year or for the rest between now and the end of the year, I think that's getting to extreme levels. But we shall see what the data comes. Banxico, they cut rates by 25 pips to 10.25% as expected. Unanimous decision for that one. They say the inflationary environment may allow for further reference rate adjustments. Goldies have updated their forecast with Bank of Canada. They now see them cutting by 50 pips in their December meeting versus prior forecast of 25 pips. They say the BOC will continue to cut rates until reaching a terminal rate of 2.25% in June 2025. They did expect that neutral terminal rate of 2.5% in their prior forecast. Over in the Middle East and the stuff going on there, it does look like we are potentially heading towards some sort of ceasefire in Lebanon, at least. All sides talking, banging around a deal. The US official says a ceasefire is not yet a done deal, but very, very close. And we've got to wait to hear what Hezbollah and the likes have to respond. That's just called a headline before we came on the show, saying that they're expecting maybe that response in the next couple of days. The US Treasury issued its FX report, and they saw the latest FX report, and they saw no currency manipulation in the final months of the Biden administration. So they acknowledged that Japan had been intervening, but said it had been well telegraphed and communicated, and that it was due to excessive moves, blah, 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 blah. So no one has been slapped on the wrist by the US Treasury. They'll be thankful for that, particularly the SNB, who really don't give a fuck what the US Treasury has to say about their intervention. And that's it for the headlines for yesterday. That's it for the week. Thank you very much. We'll see, obviously, what headlines and bits and pieces we get during the rest of the day. Right, let's have a look at what's going on. I think, as we've been saying for most of the week, you need to be plugged into yields at the moment. This is really, I would say, potentially the only real game in town regarding what the dollar might do next outside of political headlines from the US. We're still holding below this 4.5% mark. Powell's comments obviously gave it a little bit of a dip. So that's taken a bit of heat out of this move that we've seen up towards this 4.5% mark. But we're not straying too far from it. So the dollar's seeing a little bit of a pause at the moment across the board. There may be a bit of natural exhaustion in there. but a lot of pairs are looking a bit dead cattish at the moment. The main mover on this yield move has been dollar yen. That's looking a bit more weaker than some of the other pairs, although obviously there's a bit more volatility in this one than others. Just looking at a bit of the short-term chart. So we had this 155.70 level that I had on my chart. I didn't see it as anything massively important, but it's an old level, hence why it was there. And we've been messing around about it at the moment. We obviously had that spike up towards the high 156s, 157. That's washed out, as I said, a bit of Powell in there as well. And we're just holding below it at the moment. Are we done with this trend? Is that a top? Who knows? You know, doesn't look like it's anywhere close to turning around this trend yet. So for now, it's a little bit of a pullback. We'll keep an eye on the big 145. 155. See what happens if we get a retest down there. But as I said, with yields coming off, but not going too far, that will keep the bullish trend in play for dollar yen. But you know, good couple of markers here, 155, 157, to see what we can do in between that. Euro dollar, that's bounced nicely yesterday off the 105 level. I'm still long, and I know a lot of our chat room bods are long that as well. Though again, we're not out the woods. This is still a very weak bounce if you compare it to what's been going on, you know, over the last few weeks. And this is just November from the 109s, let alone the trend from 112. So it's all about small steps at the moment. We got above the top of this zone, messing around a bit, got above, then we're holding it this morning. So that gives it a little bit of a stepping stone. Then we had this sort of intermediate area, 105, 55, 60-ish. We're holding that as well now. But unless we're back above 106, 105.90, 106.11, this area here, and maybe probably more so 106.35, you know, we are still within the realms of potentially seeing this lower. This trend is not looking like it's going to change anytime soon, and this is just the short term, the last couple of weeks, still not managing to get above any of these prior lows. So it is still weak despite the bounce. It's a nice decent bounce, plenty of pips to be taken off of that one, but I've shaved down my position a bit more this morning purely because the bounce looks very weak, you know. And if we go on to a slightly longer chart, as you can see, you know, we're still looking very, very weak in this move. So the level it held, that's what you want it to do, these big levels. It's worked out thus far, but I'm not counting my chickens just yet. I'll get a bit more comfortable above 106.10. I'll get a bit more comfortable if we get above 107. But if we don't, then that keeps the pressure on this 105 level and the downside. So if you long this one as well, make sure you're taking some partials at least and protecting the rest with your stop. I've got my stop up just below this low, 104.90. I might be interested in having another little add back if we get down to 105s, but I'll see what the price action is like and what's moving it there. Some other pairs not looking as strong on the bounces. Well, if you just mark them against your own levels, particularly. Again, another sort of small intermediate level I had here around about the 126, 45, 50 area, which we just went through yesterday, but we're trying to hold it at the moment. But unlike, or pretty much similar to euro dollar, we're not getting back above this next level, this zone 127 to 126.80-ish. Okay, so if we're not getting back above there, it's keeping this bearish move alive. 126, 26.15, some have got it at 20, doesn't really matter. This is the next zone that you need to be looking at, 126. If we're busting below this low, we're probably going to have a look there. And who knows if we're going to hold that level as well. Aussie dollar again, you know, a lot of these pairs all looking very similar. Another sort of dead cattish bounce off the lows here. This level goes back quite some time, 64.40. I won't bother showing it. It's a lot similar to a lot of levels we're seeing. Can't even get back above this prior bounce. So again, lower lows, lower highs, still evident there. Kiwi had a decent bounce. I had a big level down here, 58.40s. But again, looking a bit similar to the euro dollar, looking similar to all the other pairs. You're getting the theme now. Had a bit of a wider zone here, this area, and we're just trying to get back above it. It's coming to a longer. So we did get below these prior lows, but this level, as I say, goes back quite some time, if I can show it. You can't really see it because of the long duration, but if you zoom into some of these areas, you'll see it goes back and 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 back to all these points all the way through here. So it's a decent level, funny number, but who am I to argue? We have bounced on there, a bit like the 105 in euro dollar. Not out the woods yet though. Kevin, not impressed. Not impressed, I see, mate. If you're long, at least it's holding. You know, at the very least, that's what you want to happen. The fact that it's not bouncing very far is obviously concerning. You know, this one really doesn't look like it starts turning around or looking a bit better until it's above 59. You know, this little low area down here, 59, 10, 15, more so 59.40s, 50s. Unless we're getting back above there, this one is still looking very weak. But, you know, you have to start somewhere with moves like this. So it does look a bit crappy now. Who knows? End of the day, could be a bit higher, and then that's a bit more constructive. So staying in the game is the key here. What's going on in commodities? I can't miss gold, otherwise you lot will start telling me off. Not an awful lot at the moment. What one shall I will look at first? Let's go into this one with all my little levels. I was trying to get rid of all that because I was making an example to someone yesterday. I'm a bit gutted we didn't get closer to that 25.33 area. Maybe I was just being a bit greedy in trying to see a move there, because that was potentially one of only two places that I would have looked to try gold, there or further down 24.70s, but we haven't got there. For now, it's again another weak bouncer, another dead cat one at the moment. We really don't turn this around until we're back above 25.90, 26. Okay, so we haven't even really had a test up there. We can't even get through this little pissy level, 25.70s. So that's proving a bit of a tough nut. If you get a test up here, 26, 25.90, and we hold, then again keeps that bearish momentum going. And if you're looking from the short side, that's one area where you want to lean on. If we're breaking up through that, see how we get when we get back up to this 26.20s area. And if we don't get above 26 again, don't rule out another test to the downside, and then we might see exactly what this level 25.33 is made of. So you know your range to look at the moment. Another retest and hold down here might give it the springboard to then move a bit higher. But don't know. Again, look at stuff from a closing basis. This will look particularly weak if we close down here at the end of the week. Oh, bloody hell, Gav. Too long, stopped right on the lows. Oh, mate. Sorry to hear that. Sorry to hear that. So if you get another one, be careful. If you've had two goes and they haven't worked, keep an eye on that low, because if you go back there quickly, it could be one that then goes through it. Oil, still looking bearish. Had this little bounce up 69s. Now we're coming back down again. We may get a bit of a relief rally in risk, not so much oil, but in risk in general, if we get this ceasefire coming into play, confirmed, it just might mean the start of lessening of those hostilities in the whole area. But I wouldn't. I don't know. It's one step. It's a bit like prices we're showing here, euro dollar off the 105. It's one step towards being something a bit more constructive, but I wouldn't exactly go steaming into risk on the back of that. But all those little bricks get added to the wall, and then you get a bit more something solid building up. So if we do, then a bit of peace, then we might actually see oil coming down and really giving this low side a test. And we'll see how that gets on. I'm in half a mind whether to give it a go down here. I missed out. I felt a bit itching to give it a go down here last time, and I didn't bother, and it got all the way up, back up to the zone 70s, 72s. I don't know. We back pretty quickly. I'm in two minds about this one. I certainly probably won't trade it going into the weekend. I can tell you that for sure. What can we look at next? Quick look at dollar China, because I'm interested in that one. Didn't quite get up to the 728s that I was looking for to maybe start scaling in some shorts. Bit of a pullback again. Not looking like this trend is really reversing just yet. So there's every chance that we still have a look to the upside there. Euro sterling. Let's have a quick look at that. S&P pull, no problem. We'll have a look at that in a moment. Still bouncing around the middle here, holding above 83s. We had a couple of little tests down towards it, which have held, but it's not looking like it wants to shoot much higher. So more sideways action for this one. I don't know which way to play this one at the moment. It's a bit messy between what's going on in the UK. The pound is still sitting on the weaker side. Data not helping as well. But then the euro zone isn't exactly going all guns blazing. So I expect this one to probably see a bit more sideways action. Maybe building up a bit of a range play, 83s, 84s, if you want to look at that side of things. S&P. Where are we? There we go. So we were mooching around this range, and I said yesterday, you've got to really either trade the range or pick your direction from which way it breaks, and which way it's broken is south. It's pretty much gone through a lot of levels here. You might have picked some minor levels off of here. The main one is down at this 58.75 for me. So we've had this break here. If you see a retest and it holds and you want to be short, that's your signal. So you can maybe try shorts against that if it holds back up 59.60s to see a move down to that level there. Conversely, if we're coming down here in one move, then you want to see this hold. If you're short from up here, this is a level you might want to think about taking some profit. Not because it might bounce on there and go all the way back up, but it might just pause for a bit and at least show a little bit of a rebound. So if you're short, think about taking some profit in case it doesn't carry on through that level. But like I said, yeah, the price action speaks for itself. One way or the other, it went south. That's the way it wanted to go. You don't need a bias for that. You can just trade what it does rather than what you think it might do. But yeah, 58.75s. What are you doing, Paul? In the old S&P, you're long, you're short. Hi, Wakes. Divergence is apparent between EU and US equities since post-election, even between risk currencies. Yeah, I've been speaking about new correlations regarding what's going on in the US. I think there's obviously a bit of a divergence. There's always been a bit of divergence, and there's been a bit more divergence appearing given the data in the EU and the data in the US. So yeah, that's set to grow further. I wouldn't say hugely unless the US really starts taking off. But the divergence is going to remain. yes, it's all this dollar sentiment that we've had, this rally in US yields, and it's dragged up a few of the other yields as well. There is a heavy tilt towards the US dollar strength, higher yields, be it Trump's policies, better economies, better economy, the Fed, as mentioned, maybe doing less hikes. That's all feeding into the dollar side of things, the US exceptionalism side of things. But yeah, I do think there's the potential for correlations to change. You know, the risk on, risk off sentiment manifests. You know, that's changed over the years several times. I think we might be getting another change in that as well. I don't know when, I don't know where, but I've just got that feeling. There's certain things I've seen in markets, like we did get a bit of a breakdown between the dollar and yields over the election before it all started moving the same way again. So there's just little signals that are popping up to suggest we might be getting a change in correlation. And the biggest thing traders need to take from that is if you've been trading a certain way, or your strategies follow certain correlations, you know, risk on, risk off models as it is now. If you get those changes and you find that your strategies are not working or not working as well, and something's, you know, changing within them, then you need to pause and reassess your strategies and see if something is really changing. You can obviously get short-term breaks in correlations and then they come back again. Look at oil and dollar CAD, you know, very strong correlation. The last few months, it's been virtually non-existent. So when you get that, if you're trading a certain way, based, you know, some of you may have EAs and models and whatever that trade to certain conditions. If you find they're not working once, twice, three times over a decent period of time, that's when you need to pause. Because what a lot of traders do is they think, right, I've got this system of trading, I've got this way of trading, it's been working for the last 6, 8, 12 months. And when it suddenly starts not working, they think, well, it's just temporary, it's going to come back. And then you hit a string of losses and you keep thinking, oh, it's going to come back, oh, it's going to come back, oh, it's going to come back. And then it's only after you've done a decent amount of money that you suddenly think, oh, well, maybe it's not working anymore. So you've got to look for the small moves, the small indications that something might be changing, and at the very least, just pause your trading, assess the markets, and see what's changing. Now, this is something that's probably gonna happen probably next year. Next year is when we'll really see it come to light. But you know, you may get the early clues over, you know, the last month and a half of the year, and then we'll see what happens. And I know it's like, yeah, you mentioned dollar yen. You know, dollar yen, we were playing the Bank of Japan trade against the Fed trade and so on and so forth. Okay, but if we're going to be seeing a big dollar trend based on higher tariffs, inflation, better US economy, whatever the situation is, if the US is going to be really exceptional versus everyone else in 2025, we're going to see a huge, you know, dollar rally. What does that mean for Japan? It means they're not, their rate hikes are going to make no bit of difference whatsoever. They are less powerless to stop dollar yen rising on the back of a strong US rather than the market being weaker on Japan or being dovish on Japan. So the whole trade changes, the focus changes. Okay, the Bank of Japan, you know, they can't hide behind their rate hikes because their rate hikes will be piecemeal compared to what's happening in the US. So, you know, that changes the situation. It makes intervention different. It makes the focus for Japan different. And that's one correlation or strategy that might change in the future. Paul, yeah, it's looking at, well, it's stalling. You could say it's stalling. It's not gone down in the last hour. But, you know, then we're talking back to S&Ps for those who may have just joined. So yeah, it's stalling, but it's, you know, you're still on the right side. Hopefully you're short from up here somewhere rather than just down here. If you're short from just down here, then, you know, you've got a level 32s, 40s just in the the intraday numbers. That's where you need to be careful, and maybe just here around the 20s that we keep coming up to, and just holding against. So little lines, just little levels. This is why I like watching a 15-minute chart so much, because it gives you these little levels, just to keep an eye on. If you're short from up here, fine, you're not really worried, but something might start changing if we're back above 20. Something might start changing if we're back above 30. Something might start changing if we're back above 40s. So you get these little indications just watching the price action day to day. Right, anything else for anything else? I was going to have a look at Chinese stocks, actually, just on the back of what happened with that data, just to see if we did see a bit of strengthening. Nope, not really. They're still looking downwards. We have had a decent bounce, but since the big stimulus measures, we've not really gone on to take out or have a look at those highs. And even this good data that we got today couldn't help stock markets. So still looking like, well, the market would like them to do a ton more stimulus, but we'll have to see whether they do that or not. They've done a big amount already, so it needs to start bearing fruit. And maybe the data we saw today is the start of it. Right, well, I'm done. It's been a tiring week. We've got one more day to go, or the rest of the day to go. So I'm going to leave it there for today. Thank you very much for coming to the Flow Show and supporting us here. Don't forget to tweet us out if you see the show being tweeted out as well. Spread the word. Let's get a few more people in here. Have a great rest of your day. Have a great weekend. Stay safe. Hope you have a peaceful one. See you next week.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.